So welcome again to this session today of CRAG VC webinar. Today we are going to be discussing a topic that is very critical for everyone who is conscious about climate change and livelihoods in Sub-Saharan Africa and possibly even across other geographies. And the topic for discussion today is the role of financial instruments in climate finance. So the session is going to be structured in this way. We're going to have a welcome note, and I'm going to introduce this topic. Then we're going to also see which panelists we have today. After that, we're going to have a panel discussion, and then we'll follow it up with a call to action, where we'll have closing remarks from our panelists. But before that, we'll also allow participants to ask questions with the panelists and contribute to the discussion in whichever way possible. As a housekeeping rule, please keep your mics off as they are. You can always engage with us on chat, post your questions and any comments. As this session continues, you're also welcome to interact with our posts on social media under the hashtag of CRAGVC. Like these posts, comment on them, and yeah, you can also provide more posts under the same. So straight on, I will provide some background concerning CRAGVC. And just to let you know is that CRAGVC, this abbreviation that we keep using, is basically Climate Resilient Agriculture Virtual Club. So we have 2 chapters for this CRAG, and this is the East Africa chapter. So I'm going to tell you a little bit about this CRAG VC, and its mission is to enable innovative digital solutions to for transformative changes in smallholder farmers' climate resilience. There are various members of this CRAG Alliance, and we are also always looking out for prospective members to partner with us to advance the dialogue on climate resilience, especially for smallholder farmers, through various thematic areas. So we get value out of CRAG through bringing in different partners to collaborate, to discuss, and to design solutions that help to advance the agenda of resilience against climate change. And so one of the things that we are looking at a lot in this CRAG is digital agriculture, and especially when you talk about digital solutions that enhance climate resilience. Now today, as I may have mentioned, is that we're going to shift our focus on financial instruments. So these financial instruments, we want to see how exactly can these financial instruments be used effectively to build the resilience of smallholder farmers. So thank you so much for joining this session. And I want us to start by looking at an image here. And as we look at this image, I want you to identify the commonality between the 2 of them. So I'll give you a few seconds, like let's say 5 seconds, to look at these images and identify the commonality between them. And then this information will be very useful as we continue. So once you have seen these images and identified the commonality, I want you to look at some facts that are established here. And this will help us to put some context into this discussion about climate resilience. So we have some projections here that are existing out there. So we have FAO saying that smallholder farms in Sub-Saharan Africa are about 33 million. And this is about 80% of all farms in the region, and they contribute up to 90% of food production in Sub-Saharan African countries. And so we are realizing that many crops that are foundational to our African diets, for example, maize, wheat, sorghum, and millet, will have a very hard time to survive these high rising temperatures. So, for instance, under warming of 2 degrees Celsius, crop yields across Sub-Saharan Africa will decrease by over 10%. And warming beyond the 2-degree mark will cause crop yields to fall by up to 20%. And these are very alarming statistics. And we already see that hunger is affecting about 240 million Africans on a daily basis. So by the year 2050, even a slight change of about just 1.2 degrees Celsius to about 1.9 degrees Celsius will have increased this number by about 25%. So you can imagine if you already have 240 million, and then this goes up by 25% to up to 95% in some areas, then this is something that we need to be worried about. So the question is, who is bearing this brunt, and how can financial instruments help to lighten this burden? We did some research, and this was a collaborative research between MSC Consulting, MicroSave Consulting, and Glasgow Caledonian University of Scotland. So there was a demand side and a supply side research. And on the demand side, we found that over 67% of respondents were saying that they did not see any impact of microcredit on dealing with drought. So what I'm talking about here is one of the possible instruments or financial instruments that has been applied in terms of trying to build the resilience of smallholder farmers. So we are seeing very little impact of, say, microfinance solutions or microcredit in terms of helping smallholder farmers to be resilient. So we are using findings from Rwanda, but these findings are applicable across many countries in Sub-Saharan Africa. For instance, when they were asked about the impact of microcredit on dealing with the pests and diseases, 1% are saying there is no impact. And these are very serious numbers because for pests and diseases has been cited to be a very critical indicator of the changing climate, where new pests are starting to appear in areas that they were not there before because of the rising temperatures. So if this financial instrument is not being effective in addressing that, then we are seeing some lapses that probably we want to figure out how to address. So we also looked at what makes it difficult to repay a loan, for instance. And as a trend, if you take an example in Musanze, which is one of the regions of Rwanda, we are seeing a large percentage of the respondents saying, that is 22%, that weather problems that includes drought and heavy rains was one of the things that made it very difficult for them to repay loans. So this one is speaking to the issue of resilience. On the supply side, we found a few things as well. For example, that microcredit providers like MFIs, they're operating without a dedicated agriculture lending strategy. They're just lending agriculture loans like any other loan out there. Then these providers do not have a strategy to manage climate-related risks, and then they do not have like personnel with specialization in agriculture or climate change. So we also found that microcredit providers do not incorporate climate-related risks when doing loan appraisals. And also, most importantly, that microcredit providers are not using integrated approaches to climate-related risk mitigation. So this last point is very key because we have seen very low effectiveness of microcredit on its own addressing climate resilience issues. So then what else has to be done? Are there ways of integrating some other instruments together with this? Today, we are joined by a very strong panel that will help us to break down this further. We are joined by Hedwig Stewardson. Hedwig is the head of inclusive finance at AGRA. She has over 20 years of experience in SME financing and has worked across Europe and Africa. She has worked in Kenya. She is in AGRA, where she leads inclusive finance business line, where she has overseen investments to increase inclusivity in finance across the 11 AGRA-focused countries. We're also joined by Leonard Kambona. And Leonard, congratulations. Maybe you tell us a bit about why I'm congratulating you. Leonard has been the country director at Kenya Farmer to Farmer program at International Executive Service Corps, where he has been a very long-standing financial service execution expert and digital financial services consultant. He has worked and served multiple microfinance institutions, banks, SACCOs, and NGOs. Oscar Sakanya joins us from Yehu Microfinance Services Limited. He brings this microfinance perspective. And Ruben Gisheha has also been an inclusive finance consultant. He also helps us in this discussion to see what factors are contributing to the less effectiveness of these instruments, and then how else can we make these instruments more effective. Welcome, our dear panelists. as we begin this discussion. Maybe I'll give each of you just a moment to also tell us a little bit about your recent work related to this area before we delve into the questions that are going to guide our discussion. We'll start with Hedwig. Welcome, Hedwig.
Hello. Let me put my camera on. Hi, yes, good afternoon, everybody. Yeah, glad to be here. Important topic. Climate change is real and today. So it's a very important discussion on how farmers need to deal with it. I think one of the key issues for us is that Africa is in fact the only continent that still has the resources for investments in addressing climate adaptation and mitigation. Right? Africa still has a lot of natural resources that need to be preserved because they are carbon sinks, they are climate mitigants, the forests in Congo, etc. So instead of talking about food and loss and damage for farmers suffering from climate change, I think we should reframe it as Africa being destination number one for anybody who wants to invest in climate. Right? And that money, of course, should go to farmers and should go to farmers being enabled to produce more on less acreage. Right? So sustainable crop intensification, I think that's the road to go. How we need to do that is another discussion, which we can have later. I'm not sure how much you wanted me to talk, but this is my first thing, right? So Africa is climate destination number one as a continent, and sustainable crop intensification is the route for farmers to become more sustainable. And that's what financial services should facilitate. Over.
Thank you so much, Hedwig, for that intro. Opening remarks. Leonard will be next.
Yeah, let me put on my video too. Thank you very much. Just following up with what Hedwig just spoken about, some estimates have put a funding gap for climate finance for Africa at around 140 billion, 30 billion being for adaptation, the rest being for mitigation and development of structural frameworks and policy. One of the things that I would note at the onset is that despite the fact that Africa can be the preferred and the most great destination for climate finance investment, there is no good pipeline of actual bankable, fundable climate finance projects and business models that can woo investors, particularly from the private sector. So as we move on through this discussion, perhaps we could also have insights into these gaps that can be that can be filled up, and the opportunities that can be leveraged to enable the last mile, the smallholder farmers, be able to access the full benefits and opportunities of the resource potential in climate financing and related that we have. Over to you.
Thank you so much, Leonard, for this opening remarks. Oscar, could you please tell us something as an opening remark about what you see as the role microfinance is playing in this? Oscar? Yes. Please unmute yourself, Oscar. Yes.
Okay, I hope I'm audible enough now. Okay, thank you so much. I'm here participating from Mombasa. So from a microfinance perspective, the issues around agriculture financing and the role that financial institutions, especially from a micro perspective, can play in terms of the climate change and food production as a whole, especially within the African context. At microfinance, we are faced with many challenges that make us be shy away, especially from venturing completely into the issue of lending, especially to the smallholder farmers, the element of the risk is very critical, as you know, because we are also in business, and also the issues to do with the staffing are very critical, because that's where speciality comes in to help us maybe mitigate the risk that come along as we do to support the smallholder farmers. Majority of these people really need financing. However, the people that can come in and mitigate the gap so that we can absorb that risk to go ahead and lend to these smallholder farmers within the sub-Saharan areas, it becomes a challenge. So I know as we discuss, we shall bring forth more of the challenges that we encounter as micro lenders that make us not go full hog into lending to these smallholder farmers, which are the majority. So those will be my opening remarks, but we shall progress as we go on.
Thank you. Thank you so much, Oscar, for those powerful opening remarks. We'll hear from Ruben. In your experience as a consultant, as a practitioner in inclusive finance, what is it that you have observed that you can tell us as an opening remarks about financial instruments for building resilience of smallholder farmers? Yes, Ruben.
Great. Good afternoon, everyone. Climate change is real, and it's here with us. And the thing is, how do we mitigate? How do we make the investment from smallholder farmers be able to give them realistic returns as we grapple with climate change? How we need to speak about sustainable finance beyond credit. I mean, finance that is able to lead to impact. And smallholder farmers are not just statistics, but they are families. They have families. They have aspirations. They have desires, and they would want to meet their daily needs, like taking their kids to school. They need to address medical needs. And how do these instruments smoothen their lifestyles and the way they lead their lives? And it's a real area, and farmers need to be supported by governments. Governments are the biggest owners of resources, and how can we come up with flagship models that can support them to be able to create realistic values from their investments? Discuss more. Thank you.
So much, Ruben, for very powerful opening remarks. And now I would like to just ask one question that I would like us to discuss here. We know that these financial instruments are out there in the market, and we have seen the data that are presented here that not all of them are very effective. You just used one example of microfinance. We know that microfinance has a very strong potential in terms of supporting farmers to build resilience against climate change. Say, for example, investing in climate smart agriculture as an example. But they are getting it, but they are saying that it is not helping them as much. So are these current financial instruments, are they effective in building the resilience of our smallholder farmers in this continent? Or are they just some kind of band-aid solutions to problems that are deeper and more structural in the agriculture sector? What would you think about this, Leonard?
Well, I think one of the challenges we have heard, and I think in inefficiencies in enabling these financial instruments to work, is the fact that we've looked at them as a ballpark, as a whole. The truth is that we have different types of instruments, a range of them. We have mature instruments that have been used over the years and have proved to be effective. We have those that are emerging currently, and we have those that are still in pilot stages being worked on. And most of the current know-how that we lack is the insights to be able to know which of those instruments are mature enough, which of those instruments, for example, are not yet able to provide the impact that is needed. For example, the microfinance and microcredit area being an emerging and explored area, for example, would need and require much more investment to be able to understand and build the business models, to mature it up to a level that can give confidence to investors and other partners to be able to address and invest in it. Now, it is not to be taken as a get-go that they would just invest because of the history of the microfinance and microcredit itself, but there's need to build a body of evidence. There is need to build a body of frameworks that are workable and mature enough to demonstrate that they can be able to attract financing and therefore have flows into capital flows to finance the same. So just pointing out that it's important that we begin to differentiate the different types of financial instruments and be able to see what gaps they lack in being able to woo the capital flows that is required. Over to you.
Thank you so much, Leonard, for this powerful inputs. Now, Hedwig, I have seen a facial expression, and I assume you probably want to chime in on this. As you chime in, would you also mention that in your line of work and in your investments at Agra and even before, what are these instruments that you have come across in terms of how effective they are, and which ones do you think or do you see have been most effective for smallholder farmers, especially in the context of an area like Sub-Saharan Africa?
Thanks. Yeah, I think the first point I want to make is that the lives of farmers are already very risky. Right? So you don't want to increase risk for farmers. So what you want to achieve is that their lives become less risky. So ways to do that is not to give them credit, especially not with their land or house or property as collateral. Right? Because that's, if there's a drought or if a pest or if government is not paying, then farmers will lose whatever they have. So then they will be worse off. So I think we need to look at de-risking instruments, like insurance is one of them, but also things like warehouse receipts financing, right, which allow farmers to store and to get a better price and maybe a better quality if it's linked to grading and sorting and packaging. So value addition, right, so that farmers get more money for the produce they have. I think subsidies for fertilizers, inputs, so that they can produce more, so that their investment is less on their own burden. As of input subsidy programs, and then maybe guarantees. If portfolio guarantees for farmer organizations, I think it's very important for farmers to group, to work together, so that risks are diversified among farmers, right? So that the group takes the responsibility for maybe a loan to store or to provide inputs. So I think that that's some of the things that I have seen working. And another one is maybe asset leasing, because assets are assets, right? So a loan for a tractor where the tractor is the collateral, but also smaller machines like weeders, planters, where the asset can be the collateral for the loan. Because then at least the risk of default is that they lose the asset, which is less impactful than losing your house or your land or your title. So that's what I would like to say. And then, well, maybe the last one is layaway schemes, saving schemes, easy payments, so that transfer of money, cash transfers, transacting becomes cheaper. Right? I think that is very important. We don't talk a lot about payments, but it's important, right? Because farmers sometimes carry a lot of cash, which is very risky. So yeah, that's some of the things that I've seen working and that are making lives of farmers less risky.
Thank you so much, Hedwig, for this input. And I think you have mentioned something that is very key. That's about risk. So risk is also, both on the financial service provider side, and as well, the ability to take risk on the demand side. So Ruben, I would like you to come in and just tell me what you think about this. No, we have seen these instruments that Hedvig has mentioned, and some of them have been more effective than others. And I think there is an aspect of bundling that has been in discussions. So I don't know what you think about that. Do you see if they have been bundled successfully? Have you seen instances where working together, maybe credit and insurance, work together to be more effective? Can you say something about this, Ruben?
Thanks. I would say bundling would work in a situation whereby there's a primary or a basic product offering, and then you layer a simple, maybe you layer another service without layering many other services. But when you layer, what I would say is when you layer many services onto the primary product, then the products tend to confuse the smallholder farmers, and the uptake is not usually very good. So bundled services, there has had a mixed kind of results. And from my own experience, bundled services, the uptake have been quite low. The uptake of those services have been quite low, unless whereby there is a sort of an off-taker model. There is a structured sort of market where there is a lead, what I would call there's a lead farmer or a lead SME farmer who is working with a network of smallholder farmers who is working across them, and then the lead farmer or the lead farmer provides input credit in kind. The lead farmer provides sort of manages the risk on behalf of maybe a lending institution, and then there is access to market. And then the lead farmer maybe will use instruments like farm management information system, whereby they blast good agronomic practices, when to plant, when to apply fertilizer, when to harvest, and when to deliver. With that kind of information, then the aspect of precision farming and the risk is managed by the lead farmer, as opposed to one solution that is a sort of push. It's not demand driven, but rather a kind of a push, kind of an engagement. So engagement, maybe working with smallholder farmers from primary production, whereby there are structured markets and there is an off-taker, there's a forward and backward linkage. We'll have to manage the risk, the climate risk, and then you embed the aspect of, you marry the aspect of insurance, but bundling alone is not a panacea.
Very, very strong point there. And Oscar, I would like to bring you in on this discussion, because we are talking about smallholder farmers, and who else knows them better than like a microfinance institution or like yours. I'm sure you interact with them more directly and very closely, and you probably understand very well what kind of needs they have and what kind of products they would have. Do you think if these products are bundled, do they become more complicated to these customers? Do you think it's better for them to be bundled, or what would you say about this, Oscar? Oscar, if you can hear me.
Yes. Okay, I can hear you. I think you can hear me now.
Yes, I can hear you now.
So I think we have a lot that is talked about within the agriculture sector at large about the smallholder. But in terms of the actual solution being presented to the farmer, it's still at a very small level. For instance, the issues about the de-risking when you're incorporating insurance within the agriculture sector, you will find very few institutions are willing, the insurers are willing to take up that risk in terms of trying to de-risk people like us in the microfinance, so that we can be able now to extend the benefit of lending to the small scale farmers who are the majority now. So those solutions are talked at a very high level, but we don't, they are in actual sense of them trickling down to the real farmer, there isn't. We could talk of things like the access to market, the solutions that are around that, where people of takers and all these people are left to the farmer is left to the fate of them, so that at some point they show up. So you can end up extending credit to a farmer, but the surety that those crops will be taken by the so-called off-taker it's not there. Some of them end up signing contracts that are not honored. At the end of the day, the farmer is left with crops that they probably the things they planted things that they might not need. And if you extend that credit to people like that, then you end up at a loss. Majority of the farmers still are still dependent on rain-fed agriculture. And this one comes with its own challenge. I think at the beginning of the presentation, you showed us some photos where maybe the contrast, some is flood, some others extreme drought when they have already planted. Now, and those are just because of the issues of it being rain-fed. And there is no way, whenever we want to extend credit to farmers that is pleasant, that can accommodate their needs, we find it so hard. And that's why we end up being blamed for lending business loans, agriculture loans as business loans. Because whenever you can give the issues of grace period, at what period do we now demand money from the farmer? You have given out money to a farmer that crop where you take 4 months, 5 months to mature. But we end up demanding at the second month, because even by the time we give the farmer the 4 weeks or the 5 weeks grace period, so that the 4 months grace period, there's no guarantee that we are going to get that money, because it may end up either the pest will come in, rain will come in, or drought will set in. So we end up losing everything. And then the issues around collateralization, they are still very complicated. So guarantees, these guarantees are talked about still at very high level, but in terms of them trickling down to us so that we can be able to sustain the same benefit to the farmer, we don't see them. We are still accessing credit at a very high. Remember, microcredit, we don't have a pool of funds that we are able to lend to the farmer at a lower rate. No, we are going out to the market rate. Those people who specialize in agriculture, they still have a lot of demands on us so that they can give us funds. So we still get money at a very high rate. And then we are expected to lend to the farmer at reasonable rates, which is not possible because we have accessed the money at the market rate. So the microfinance industry, in terms of us being able to plug in effectively to support the farmer, is still very dicey and very risky.
I hear you, Oscar, and that is a very important point. As we look at this, as we discuss this, you're saying we have to look at it from both sides, the demand side and the supply side, so that it works for you in a business sense. It makes a business sense on your side, as you also try to reach out to the end users. And I'm seeing a very lively discussion within the chats. Please keep that going. And if you have any questions, also post them there. We will forward them to the panelists who will help us to break them down. So I think from what I'm hearing, the discussion is saying that it is not that simple, you know, and even from the chat, I can see that even bundling alone is not as effective as it may seem. And so it means we probably have to, you know, dig deeper and look into more comprehensive solutions to this. So it looks like there are probably some structural problems that we need to address that will help us to effectively build the resilience of smallholder farmers using these financial instruments. So I would like us to extend this discussion and look at the angle of inclusivity. You know, we have different categories of different types of farmers. Even as we talk about the smallholders, it's not a homogeneous group, whether it's in terms of geography, whether it's in terms of gender, whether it's in terms of many other aspects. So the question is, how can we ensure that these financial instruments are designed and implemented in a way that is inclusive and is accessible to all smallholder farmers, including those that are traditionally marginalized or that are excluded from the formal financial systems? Because if it is microfinance, if it's microcredit, they need to be having some kind of inclusion. So how about we make it more inclusive? Is there a way that we can make it more inclusive than it is already? Or is it inclusive enough right now? First on this, I would like to hear insights from Hedvig.
Hi, thank you. Yeah, I think if you talk about inclusivity, I mean, I think I would like to talk about financial inclusion, right? Because, I mean, not everyone needs financial services, right? people always talk about farmers needing access to credit. I don't agree, right? I think they don't need access to credit. Farmers need what it takes, what they need to produce, and that is inputs and markets. And how that's being financed should be at the least risk for the farmers. So I think if you talk about financial services and inclusivity, I think more of payment systems that should be inclusive, right? Everybody should be able to transact and keep their money safe. So the digital literacy discussion is very important. I think everybody should be digitally literate. People should be enabled to get access to digital money, to digital accounts, because that's inclusivity, right? For me, inclusivity doesn't mean that everybody needs to have credit, right? In my own country, in the Netherlands, very few people have loans, right? It is as if everybody needs loans, but that's not true, right? So then people only borrow maybe for buying a house, but that's the only thing that people borrow for. So that whole idea of people needing credit, I don't agree, right? So for me, inclusivity is money should be able to flow where it's necessary, and that's, I mean, it's entrepreneurs, it's people that can add value to credit and that can use credit productively and earn more with money than losing it. I mean, that's where credit is due, right? So I saw a question. I don't know how we want to relate this to climate. I saw somebody chatting, but I couldn't read it fast enough. But I think in terms of the climate discussion that we are having here, it's of course terrible that the people that have contributed the least are suffering the most, right? So I think there is correction to take place. And for me, the correction that needs to take place at smallholder level is that they are being allowed to invest in crop intensification, right? So that farmers don't need to go and deforest more land to increase their production. So that is where climate funding needs to go, I think. It needs to go to crop intensification and to food loss reduction, right? So that farmers, what they produce will also be eaten, right? Currently, there's around 40% of what is produced in Africa is being lost just because it's standing too long in the field, because the post-harvest handling is wrong, right? People using sticks to get the kernels out of the maize cobs. I mean, those type of things. That's where our food gets lost and where farmers lose income. So farmers should be enabled through, I think, grants and subsidies to invest in tools that help them to reduce the food losses, right? It can be as simple as a tarpaulin, as simple as an hermetic bags, right? So that the insects do not come in. Simple things like AflaSafe, right? So that aflatoxin has less chance. I mean, those are the quick wins that are really helping farmers to get more income from what they produce, lose less, be more food secure. So yeah, that is, I think, and that's not necessarily a financing solution, right? That's more a technology access discussion.
Very powerful indeed. I think it's a very important point to say that, it's not just a matter of giving them the money or the finances. It's also looking at what other, accompanying or complementary solutions they need alongside this financing. So also directing it to the right area, not just giving them a loan to buy better seed varieties, also probably looking at the post-harvest losses, which is also a critical issue when it comes to talk about sustainability. So I get that point very well, and it's, I think, one of the most important points we're getting in this discussion. So I would just like to bring in Leonard in this point about inclusivity. And we are trying to see, we want to reach every farmer out there in their own situations, and we want to ensure that our reach to them is effective. And we've had insights from Hedvig in terms of looking at where to direct these instruments and what other supplementary solutions we need to bring along as well. So what would you say, or what, from your experience working with farmers, what would you say would be the best thing or the best path to follow when trying to achieve inclusivity on you and using financial instruments to build resilience of smallholder farmers?
Thank you very much for that invitation, and Hedwig for the discussion. As at now, we have around 4 portfolios that have been, or financial services that have been spoken to. That is the credit, and also speaking of insurance, and Hedwig had also talked about the payments. I'll just want to add one more that from my experience, we have seen that is important to have. That is the savings bit of it. I call this one the 5-pack. I coined a term for it and say the 5-pack. And that's where my contribution comes in, that most of the financial instruments, particularly at the last mile, have mostly been restricted to either a part of these needs, and have not looked at a 360-degree design kind of focus on what do these farmers need from end to end. Because if you look at the nature of agriculture, which is a key driver of green growth, for example, you will notice that unlike other value chain activities outside agriculture and other sectors, it mostly lends to end-to-end support for it to be able to be successful. So it's important that financial service providers think about going the extra mile to provide the full suite. And now they may not provide it as their own because they may need to create a niche, but they may have to be able to develop integrations, either vertical or horizontal, to enable them provide these services as a whole. The second aspect is if we move one step up to the de-risking tools, particularly if you look at debt, for example, as a tool that is being provided to the financial service provider to own land or to be able to upscale. We have noted a trend where most of it has been objective driven as opposed to being investment driven and sound and need based. For example, you'll hear of terms, and these are now familiar, of a blue bond or a green bond or a social bond or a gender bond, which speak to the objective of these particular instruments. And I think it's time for us to move from these broad objectives and go more into the need. For example, is it for risk recovery? Is it for risk preparedness, for example, etc.? And that will help be able to refine much more where that flow should go, because one of the challenges we've had of having financial flows is that the channels through which they flow has been fragmented, and defining these and moving it away from the objective focus to more or less demand and investment responsiveness will be key. And finally, speaking about the climate, on the climate change and climate resilience, specifically, it is important, and I think we sometimes ignore this, that climate resilient financial tools should be climate responsive. I think before we run away to design these financial instruments, I think there's always a need to pause and reflect and say, are they climate responsive? Indeed, most of them are not climate responsive per se, and are only, for example, meant to be able to satisfy sustainability and profitability concerns, as opposed to enabling the farmer to adapt and build resilience against the vagaries of climate. Over to you.
Thank you so much, Leonard, for this very powerful contribution. I would like to bring in Oscar, and just also to benefit from your perspectives, having been very close to these farmers, or who are the end users that we actually target to build their resilience. What are the segments of these farmers that you see are probably disadvantaged in a way when we talk about these financial instruments, and maybe from your perspective, the microfinance as one of the instruments? Have you seen any forms of, inequality in terms of benefits to this those smallholder farmers from interactions with them?
Yes, there is a lot of inequality within the agriculture, especially for those which are at the lower end of the pyramid, the one we call the smallholder farmers. The smallholder farmers are still segmented into various categories depending on their financial muscles and their financial strength and their ability to access credit or financial support. Especially, for instance, some parts where there is also a lot of, there are those farmers who are small, but they have some level of, they are a bit enlightened. And then there are those that are not enlightened at all, those that are, high level of ignorance. in terms of even the knowledge, accessible to knowledge and financial literacy as a whole. So you find there's a lot of disadvantage, and the way you handle them is quite different. There are those that have who have a bit enlightened, and though they are within the small scale, but they have some level of knowledge on what is supposed to be done and some degree of financial literacy. There is not the same way you will treat them as you will treat somebody also who is maybe interior parts of the country, and they have no knowledge at all on what is supposed to happen, even the very basic of financial literacy. So we are supposed to serve all of them, and sometimes we end up bundling the solutions that are available into because as somebody has pointed out, some of these financial institutions, and I will not blame them, because they are also in business and they are profit driven. So you will find, in terms of them conducting the actual research, so that they can be able to offer tailor-made solutions to every category of the farmers. It's not that luxury of either time or resources is not there. They will they will address needs. They will address those needs as long as it makes business sense to them. So you find farmers, some farmers are quite disadvantaged, like those who don't have the very basic of financial literacy. Probably they are unbanked. They have no access to banking services. They have no access to maybe savings where they can do savings. The cooperatives, probably they don't exist within some of those areas. So you find they are quite disadvantaged, and a financial institution that wants to venture to those particular areas and really support you, you have to discover that you have to use quite a lot of resources for you to be able, number one, to reach them with your services, and number two, to be able to offer some of these solutions so that you are able to support the agricultural enterprises. So at a microfinance level, you find now the farmers have to drive themselves towards the financial institutions, as opposed to us making deliberate effort to be able to reach them. And this is because of the cost implication of the same. Trying to reach some of these parts, it can be quite expensive, and we end up having a completely marginalized area with farmers. They produce a lot, because we see trucks moving there and coming up with some produce and coming up with what the end products of the farmers. But in terms of us, financial institution being able to make deliberate efforts to be able to support them and reach them is not easy. Let me use that word, because we have made attempts, but they end up failing. And then the instruments that are being talked about in terms of even the accessibility to the markets that they are there, not very many buyers or off-takers will be willing to go and collect small quantities from different periods, which makes the enterprise quite expensive. They will prefer those that are a bit established, that they can congregate together and bring their stuff together within the shortest period, and they're able to help them take their produce. But for these smaller ones that are quite at the end of the pyramid, there are quite many. They produce quite small quantities, and it becomes expensive to venture to them and be able to support them.
Very true, Oscar. I agree with you a lot, and you are bringing in very, very vital, very powerful points. And at this point, I just want to bring in Ruben. Just take about 2 minutes to tell me what you see would be an inclusivity approach when designing financial instruments. What would we have to consider? Just take 2 minutes.
Thank you. From where I see it, I see an opportunity whereby everyone involved, every actor involved, or every player involved looked at a business case. For instance, if it's a financial institution, from where they sit, they would like to look at a business case. Is there a business case for serving smallholder farmers in the realities of the climate changes or climate risks? If it's a smallholder farmer, where do they see an opportunity? Which crop can they grow and be able to looking at farm level profitability or looking at crop level profitability? Where are they able to derive the most margins and incomes by to borrow Hedwig, intensification. How can they be able to increase productivity based on their plot of land and increase productivity and be able to access structured markets and be able to get margins? So by looking at models that have worked and being replicated, and that's where how government comes in with tools like smart subsidies. They can be able to support smallholder farmers by maybe helping them to increase maybe corporate governance in their farmer-based organization, in cooperatives, so that they are able to access input and output markets, such that they're able to get improved seeds that are prone, that are weather resistant. I mean, that are able to withstand extreme weather conditions, that are able to withstand pests, they're able to apply good agronomic practices, and that can only be done maybe through smart subsidies, working in farm organization, cooperatives, and then when it comes now to organizing markets, organizing large off-takers, like, and I'm happy like in Kenya, where the government is coming up with special economic zones, processing zones, where there are tax incentives and benefits. When you set up, you get tax holiday incentives and tax holidays. So a multi-pronged approach where it involves the private sector, the government, the farmers themselves, where everyone is a winner, everyone is, there's a business case for every party that is involved in that transaction. And that's how maybe a financial institution will come in and be able to create, maybe give credit where sustainable credit, and if it's an insurance company, come up with a solution like micro pension for smallholder farmers so that they can be able to prepare for their old age, and everyone is getting, but there's a business case for everyone. And maybe for philanthropic entities or public good entities like AGRA, they come in as honest brokers, and they're able to organize the farmers and be able to replicate those models in other jurisdictions and adoption whereby farming becomes profitable to everyone, and especially to the smallholder farmers in the realities of climate challenges.
Makes a lot of sense. Makes a lot of sense, Ruben. And this is also a very powerful point. At this point, I mean, this discussion, we would have needed 2 hours maybe or more to have this discussion, because I see a lot of points also flowing in on the chat. And I would like to invite 1 or 2 questions from the audience before we move towards the close of this discussion. I mean, we will continue this discussion on our socials. You can find us on LinkedIn under the Prague VC hashtag, and also under the MSC, and also following our panelists, you'll be able to see these posts, and we can engage more in this discussion. I see some comments within the chat. I don't know if someone would like to ask a question directly. You can raise your hand so that we can give you this chance. And as we do this, our panelists, please prepare 5 seconds closing remark. Do we have direct questions from the audience that you'd like to ask? I see circularity expert has mentioned that Hedwig has mentioned the issue of margins that can be breached through productivity. He adds that the margins are a factor of client resilient seeds, investment into technology, not rely on rainfall, and ultimately access to defined market. That is market systems approach. Very powerful points there. I've also seen very many contributions from Farid Care, mentioning what ECA Africa has done. I've also seen a lot of contributions from Emeka and Nwachinemere, if I wrote that name correctly. Thank you so much, Emeka, for your contributions in this discussion. So I don't know if there is a question you'd like to ask the audience, or maybe someone will have to like to make a contribution. You're given 1 minute. Emeka Nwachinemere, I see you are here, and you have given us a lot of thoughts here. Do you want to 10 minutes to highlight or to summarize what your thoughts are?
Hello, everyone. My name is Emeka Nwachinemere. I run Kitovu Technology Company. We focus on working with smallholder farmers to make them climate resilient. Interesting discussions we've had here. One of the things I would like to contribute is that when it comes to trying to ready the continent, when it comes to climate adaptation or climate resilience, there is no single solution that is going to work if it does not take a multi-stakeholder approach. It's not going to work. The truth is that over 80% of our production is done by smallholder farmers, which means that they are very, very critical if we want to achieve anything. Now, these guys, they typically do not have the purchasing power to outrightly purchase some of these products. So, which means that it is important to structure products in a way that a funding element comes in. But for the funding element to come in, there is need for data, which is where a lot of agri-tech companies come in. At the same time, it also needs to be de-risked, which is where insurance comes in. So a one-sided approach is not going to cut it. It's very, very important that if we really want to solve these problems, which will and is already impacts our food sovereignty and food security, it's important that we approach solving these problems in a multi-stakeholder approach. While we have very, very fantastic products and solutions in different areas, they are largely working in silos. They must come together if we will make any serious dent in terms of the problems that face us. Thank you.
Thank you so much, Emeka. And now I'm giving a few seconds to Farida Kea to also say something as we move towards the end of this discussion. Okay, Farida.
Good to Farida is more feminine where I come from. So thanks. Probably a lot has been already alluded to by my colleague who just spoken a few minutes ago. Yeah, I agree. A lot of things are happening in silos, and I guess if we are able to shout about it, then probably other people can realize what other people are doing and probably join the bandwagon. But a lot of interventions are beginning to work. For a long time, we've been saying these interventions are still new, but we've been already in the market for more than 10 years. We are seeing financial institutions embracing lending to smallholder farmers, using just agriculture insurance as a collateral for the smallholder farmers. We've worked with Agra, for example, in terms of supporting last mile reach to smallholder farmers, where we are training village champions in the rural areas who not only just train farmers on agriculture insurance, but are training them on good agronomical practices, financial inclusion, record keeping, and many other things that would affect production, and bringing in other stakeholders. I mean, we look at our approach from what we call integrated risk management, that for it to work, you need financial institutions for financial inclusion, you need input companies, you need extension services, you need insurance, you need off-takers and everyone else to be able to work within that space. So I agree, a lot still needs to be done, but I mean, still things are still ongoing, even as we speak, within the Sub-Saharan African market that we operate in. Thank you.
Thank you so much. Sorry for misspelling your name, Farid. Okay, so we have come towards the end of this discussion, and I would just like to give a few seconds to each panelist to give us 3 sentences of closing remarks as we end this discussion on this platform, but we open it up on the socials. I'll start with Hedvig.
Yeah, thank you. I think we need to address climate change in Africa by diversifying and intensifying crop production and by reducing food losses. I think that brings us a long way, and that will need us to focus on small farmers, because that's where the crops need to be grown and that's where the food losses occur. So these 2 things should be on top of all of our agendas, whether we do finance or whether we are a value chain actor, whether we are an NGO. So that's my advice.
Thank you. Very strong, good advice. Let's have Leonard.
Thank you very much. And looking at what has been said and the charts, my parting shot is that we need to also be able to develop the capacity of local organizations, such as cooperatives. These are innovations in organizational design that have proved to have matured over time, and they can make a big difference in upscaling the resilience responses that will particularly create an aggregate demand for climate finance and the financial instruments. Thank you.
Thank you so much, Leonard. Oscar?
Okay, my parting shot is that we as the microfinanciers, we are really in touch of the smallholder farmers, and we really need support, both from government and all other institutions that can be able to support the microfinance institutions so that they are able to support effectively, offer the much needed support to the farmers. So that is my plea this evening, this afternoon.
Thank you so much, Oscar. Let's also hear from Ruben.
Those with opportunities to speak to those that pass the message to those in position of authority, like in government, those in policy making seats. Let's pass the message to create conducive environment and to create, maybe to provide pilot capital, seed capital to facilitate climate investments by creating opportunities and policy environment for investments in climate smart instruments. Thank you.
Thank you so much, Ruben. Thank you so much, Oscar. Thank you so much, Leonard. And thank you so much, Hedwig, for making time to join us in this discussion and providing very valuable insights based on your expertise and experience. Thank you also very much to participants who have contributed to the conversation that has been ongoing in the chat. Special recognition to Farid Care, who has given very valuable contributions. Also recognizing Paul Kweheria Kamkamuntu, and also Mr. Emeka, and not forgetting Graham, who has also been very active in the chat. Also thanking all of you for making time to attend this discussion. We are hoping that you have at least gotten one or two things as lessons. And if you are a public sector player here, you're a policy maker, you're a decision maker anywhere, I'm sure, or I hope the inputs or insights that you've gotten from here are going to influence your thinking and also going to propel the debate and the dialogue about building the resilience of smallholder farmers, and generally on the debate of climate resilience in Africa. We thank you so much for attending this, and we welcome you to future engagements under the CRAG VC webinars. We have these webinars every 2 months, and we will keep inviting you. Please also send this to your colleagues and friends so that they can also come and engage in this kind of discussions with us to continue propelling this dialogue. Thank you so much. We've shared the link, and we always welcome you, and we hope to see you again in our next webinar. Thank you so much.
Thank you.